Preparing for a finance roles at PenFed Credit Union interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work in finance at PenFed Credit Union? PenFed appeals to me because finance directly supports members while maintaining strong institutional performance. I am drawn to the combination of banking analysis, disciplined risk management, and a mission serving military personnel, veterans, government employees, and their families. My experience with financial modeling, reconciliations, and communicating insights would help improve decisions around lending, liquidity, and profitability. I also value the cooperative structure because sustainable earnings ultimately strengthen member benefits and long-term financial resilience. While answering, connect your finance skills to PenFed's member-owned structure, national scale, military community, competitive products, risk discipline, and commitment to serving members rather than focusing only on profit maximization. Question 2. How would you assess PenFed's financial performance? I would begin with earnings quality, reviewing net interest income, net interest margin, non-interest income, operating expenses, and return on assets. Then I would examine balance sheet growth, deposit funding, loan mix, delinquency, charge-offs, allowance coverage, liquidity, and capital adequacy. I would compare results with budget, prior periods, and relevant credit union peers. Finally, I would separate temporary market effects from recurring trends, because sustainable member growth and risk-adjusted profitability matter more than one strong quarter. Make sure to cover net interest margin, loan and deposit growth, credit quality, liquidity, capital ratios, operating efficiency, non-interest income, member trends, and comparisons against budgets, peers, and prior periods. Question 3. What drives net interest margin at a credit union? Net interest margin measures the spread between earning asset income and funding costs relative to average earning assets. At PenFed, key drivers would include loan pricing, securities yields, deposit and borrowing costs, product mix, and how quickly assets and liabilities reprice. A rising rate environment can compress margin if deposits reprice faster than loans. I would analyze both balance and rate effects, then evaluate whether changes reflect sustainable pricing, temporary liquidity positioning, or emerging competitive pressure. In your answer, discuss asset yields, funding costs, loan and deposit mix, repricing speed, interest rate environment, liquidity balances, hedging, non-accrual assets, and the distinction between margin expansion and balance sheet growth. Question 4. How would you analyze the impact of rising interest rates on PenFed? I would assess both earnings and economic value effects. For earnings, I would model loan and investment repricing against deposit betas, withdrawal behavior, and wholesale funding costs. For value, I would examine duration, mortgage prepayments, securities valuations, and the sensitivity of economic value of equity. I would run gradual and instantaneous rate shocks, including curve steepening and inversion. The resulting actions might include pricing changes, hedging, security repositioning, or adjusted loan production targets. Be sure to mention deposit beta, asset repricing, duration, fixed-rate mortgages, prepayments, securities valuations, net interest income sensitivity, economic value of equity, and management actions under multiple scenarios. Question 5. What is asset-liability management, and why is it important at PenFed? Asset-liability management coordinates the balance sheet so funding, liquidity, and interest rate risks remain within approved limits. I would monitor repricing gaps, duration, deposit behavior, loan prepayments, liquidity sources, and capital sensitivity. At PenFed, this matters because a large mortgage portfolio can carry long asset duration while member deposits may reprice or leave quickly. Effective ALM supports competitive rates without taking excessive earnings or economic value risk, and it informs treasury and product decisions. Focus on matching asset and liability cash flows, managing interest rate and liquidity risk, monitoring maturity gaps, modeling scenarios, protecting capital, and balancing member pricing with stable long-term earnings. Question 6. How would you evaluate a consumer or mortgage loan portfolio? I would segment the portfolio by product, vintage, geography, credit score, loan-to-value ratio, and borrower characteristics. Then I would track delinquency roll rates, non-performing loans, charge-offs, recoveries, prepayments, and allowance coverage. For mortgages, collateral values and local housing conditions are particularly important. For consumer loans, income stability and payment behavior matter. I would compare actual performance with underwriting assumptions and stress unemployment, home prices, and interest rates to identify emerging concentrations. Cover portfolio composition, underwriting quality, borrower characteristics, delinquency migration, charge-offs, collateral, loan-to-value ratios, geographic exposure, vintage performance, concentration risk, and expected loss trends. Question 7. Explain CECL and how you would support the allowance process. CECL requires estimating expected credit losses over a financial asset's contractual life, rather than waiting for a probable loss event. I would support the process by validating loan segmentation, reviewing historical loss rates, assessing forecast assumptions, analyzing qualitative adjustments, and reconciling model outputs to the general ledger. I would also investigate period-over-period changes and ensure documentation supports management judgment. Strong governance matters because allowance results affect earnings, capital planning, and confidence in reported financial statements. Mention lifetime expected credit losses, reasonable and supportable forecasts, historical loss experience, segmentation, qualitative adjustments, model validation, documentation, governance, and reconciliation to the general ledger. Question 8. What financial metrics would you monitor for credit risk? My core dashboard would include delinquency by bucket, non-performing assets, net charge-offs, recoveries, provision expense, allowance coverage, and criticized or watch list exposures. I would also monitor loan growth, concentration limits, risk grades, vintage performance, and borrower level indicators where available. Trends matter more than isolated ratios, so I would investigate migration from current to delinquent status and compare results with budget, historical cycles, and stress scenarios. That approach helps distinguish normal volatility from deteriorating credit quality. In your answer, include delinquency, non-performing assets, net charge-offs, provision expense, allowance coverage, loan growth, concentration limits, vintage trends, risk grades, and stress loss estimates. Question 9. How would you assess PenFed's liquidity position? I would review cash, marketable securities, expected inflows and outflows, deposit stability, borrowing capacity, collateral availability, and contingent funding sources. I would test normal and stressed conditions, including rapid deposit runoff, reduced market access, higher collateral haircuts, and unexpected loan draws. Liquidity should be sufficient without holding excessive low-yield assets that weaken earnings. I would report early warning indicators and confirm that contingency funding plans, limits, and escalation procedures remain practical and current. Discuss on balance sheet liquidity, contingent funding, deposit stability, cash flow projections, stress testing, collateral availability, borrowing capacity, regulatory expectations, and the trade-off between liquidity protection and earnings. Question 10. What is the difference between a bank and a credit union from a finance perspective? A credit union is member-owned and typically organized as a cooperative, while a bank is generally investor-owned. That difference influences governance, tax treatment, capital generation, and how earnings are allocated. A credit union may return value through competitive rates, lower fees, or better services, while still retaining enough earnings to build capital and resilience. From a finance perspective, I would apply the same discipline to profitability, liquidity, and risk, while recognizing that member value is a central objective. Be sure to explain member ownership, cooperative economics, tax treatment, capital generation, product pricing, member eligibility, retained earnings, regulatory structure, and how mission and profitability can coexist. Question 11. How would you build a budget for a financial institution? I would build the budget from operational drivers rather than simply applying growth percentages. I would forecast loan originations, paydowns, deposit balances, pricing, market rates, investment income, staffing, technology costs, credit losses, and capital needs. I would create base, upside, and downside cases with explicit assumptions and responsible owners. During the year, I would compare actual results with budget, isolate volume, rate, mix, and timing variances, and update the forecast when business conditions change. Focus on balance sheet assumptions, loan and deposit volumes, pricing, rate curves, credit losses, headcount, technology spending, capital requirements, scenarios, ownership of assumptions, and variance reporting. Question 12. Tell me about a time you found an error in a financial report. In a monthly reporting package, I noticed that interest expense appeared inconsistent with the average funding balance. I traced the variance to a mapping issue that assigned one borrowing account to the wrong rate category. I confirmed the issue against source statements, quantified the impact, informed my manager, and corrected the report before distribution. I then added a reasonableness check comparing balances, rates, and expense across periods. That experience reinforced the value of independent review and clear audit trails. Make sure to explain the situation, your validation steps, root cause analysis, communication style, correction, control improvement, and measurable outcome without blaming colleagues or overstating your role. Question 13. How would you explain a complex financial analysis to a non-finance manager? I would begin with the business question, not the spreadsheet. For example, if evaluating a loan pricing change, I would explain the expected effect on member volume, margin, risk, and capital using a simple chart or a few key numbers. I would define technical terms only when needed, state the assumptions clearly, and separate facts from judgment. I would finish with a recommendation, alternatives, and the decision's main risks, then invite questions to confirm understanding. Discuss starting with the decision required, simplifying technical language, using a few relevant metrics, connecting analysis to business impact, testing understanding, and offering clear recommendations with assumptions. Question 14. Which Excel or financial analysis tools do you use most effectively? I use Excel for structured analysis, including XLOOKUP, SUMIFs, index match, pivot tables, charts, and scenario tables. For recurring data, I prefer Power Query to standardize imports and reduce manual manipulation. I build checks for missing records, unexpected totals, and balance sheet tie-outs, then document assumptions and maintain clear input, calculation, and output sections. I have also used dashboards to summarize trends for managers. My priority is an analysis that is accurate, repeatable, and easy to review. Mention specific functions, pivot tables, data validation, Power Query, dashboards, scenario analysis, reconciliations, version control, and how you verify outputs rather than merely listing software. Question 15. How would you investigate an unfavorable variance in net interest income? I would decompose the variance into volume, rate, mix, timing, and classification effects. I would compare average earning assets and liabilities with budget, review loan and deposit pricing, identify unexpected prepayments or paydowns, and examine changes in investment balances or funding costs. I would validate data interfaces and accounting classifications before concluding that performance changed. Finally, I would determine whether the variance is temporary or structural and recommend actions such as repricing, funding adjustments, or forecast updates. In your answer, separate volume, rate, mix, timing, and classification effects. Review product-level data, funding costs, earning assets, forecast assumptions, and determine whether corrective action is required. Question 16. How do capital ratios affect financial decisions at a credit union? Capital provides protection against losses and determines how much balance sheet growth PenFed can safely support. I would monitor the applicable net worth and risk-based capital measures, then connect forecasts for earnings, loan growth, asset mix, and credit losses to projected ratios. Faster growth may improve income but consume capital, especially when assets carry higher risk weights. Management must balance member pricing and strategic investment with sufficient buffers for stress scenarios and unexpected losses. Cover retained earnings, asset growth capacity, risk-weighted assets, stress testing, regulatory buffers, dividends or member pricing, growth trade-offs, and the need to preserve resilience during downturns. Question 17. Describe a time you had to meet a tight deadline with incomplete data. For a time-sensitive forecast, one business unit submitted data late, leaving an incomplete expense view. I first identified which missing items could materially affect the decision, contacted the owner for a rapid estimate, and used historical run rates for immaterial categories. I clearly labeled assumptions, produced a preliminary range, and explained the uncertainty to stakeholders. Once final data arrived, I reconciled the estimate and updated the analysis. This allowed timely action without presenting assumptions as precise facts. Focus on prioritization, data quality judgment, transparent assumptions, stakeholder communication, interim analysis, validation, and how you protected decision quality while delivering on time. Question 18. What controls are important in financial reporting and forecasting? Important controls include reconciliations between subledgers and the general ledger, segregation of preparation and approval, restricted system access, documented assumptions, and controlled model versions. I would use automated checks for completeness, duplicate records, unusual movements, and balance sheet tie-outs. Management review should focus on significant variances and judgmental estimates, not merely sign-offs. When an exception occurs, I would document the root cause, correction, owner, and remediation dates so the control environment improves rather than simply records the issue. Be sure to mention reconciliations, segregation of duties, approval workflows, access controls, automated validation, version management, variance reviews, documentation, and timely remediation of control exceptions. Question 19. How would you evaluate whether a new member loan product is financially attractive? I would model expected volume, pricing, funding cost, operating expense, credit losses, capital usage, prepayments, and liquidity needs. I would calculate contribution margin, return on assets, risk-adjusted return, and break-even volume under several scenarios. I would also consider member demand, competitive pricing, operational complexity, and cross-sell benefits. A product can be strategically valuable even with modest initial margin, but the decision should identify the required scale, major risks, and clear performance milestones. Discuss pricing, expected balances, funding costs, operating expenses, credit losses, capital usage, liquidity, member demand, cross-sell potential, break-even analysis, and sensitivity to economic or competitive changes. Question 20. What would you do if a senior stakeholder challenged your financial conclusion? I would treat the challenge as an opportunity to test the analysis rather than defend it emotionally. I would ask which assumption or data point concerns the stakeholder, review the source information, and reproduce the calculation independently. If my work were wrong, I would correct it promptly and explain the impact. If the conclusion remained sound, I would present the evidence, sensitivities, and limitations clearly. The goal is a reliable decision, not winning an argument or protecting a prior position. In your answer, emphasize listening, understanding the challenge, revisiting data and assumptions, separating facts from judgment, remaining professional, escalating appropriately, and updating conclusions when evidence warrants it. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.